On Friday, tariffs were ruled illegal by a federal appeals court. But as it stands, tariffs are to remain in effect until mid-October or until the Supreme Court rules on the issue. However, markets should respond negatively to the uncertainty, primarily due to the potential, keyword, loss of investment commitments. But it's not just tariffs. It's the fact that seasonally September is one of the worst months for markets. We know that semiconductors are slowing down after hearing NVIDIA earnings, but will the rotation into financials be enough to keep this market afloat? That's what we'll get into in today's episode of the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off today on the SPX monthly timescale now that the August bars have officially closed out. And you'll see why we're using the SPX in a moment, but for now, candle structure and location, right? What do we see here? Solid green-bodied bar, very minimal wicks, strong close from the buyers near the highs of the monthly range. I would argue structure is bullish. In terms of location on the bar-to-bar count, higher low as well as a higher high, and a close outside of and above by just a small margin the previous month's range. So candle structure and location side with the bulls, and obviously the trend here remains in the upward direction, noting that this is a brand new all-time high close on the monthly timescale. And the current trend count says that we have lows, soft higher low, firm higher low, soft higher low, firm higher low. There's plenty of room for a firm higher low pullback, meaning that the weekly trend would flip to down, and yet we could still navigate towards a monthly higher low, noting that, of course, once again, we have this sort of opportunity because we would be pulling back from the highest high in the trend count. There is no trend reversal. Again, why is this so important? I know we check in every single time when we get a monthly close, but the big watershed moments where there's pain in the market generally happens when the monthly trend flips to down. Remember, in the dot-com bubble bursting, we had a double top. Here's your lower high, here's your lower low, and then we get painful moment number 1, painful moment number 2. It's a little bit more clear in the Great Financial Crisis with your double top here. Here's the neckline. Here, of course, is your lower high. Massive painful moment. And you might be saying, like, well, those are just the 2 more recent big major bear markets. Well, it goes back further than that, hence why we're using the SPX, not the SPY. You can see here, when the monthly trend flips to down in the late 60s, there's your lower high. Here's your lower low, then you get another painful moment. When you get the head and shoulders here in the early 70s, then you get another painful moment. So the point of the exercise is to sort of look at the higher time scale and say, do we have a threat currently of a monthly trend reversal? And the answer to me is absolutely not. And therefore, even if September ends up being a little bit of a harsher month to the downside, I mean, I know we talk about this higher low on the weekly timescale as well, but something that looks like that, if the month of September is down and then we see a little bit of a rally into the end of the year, no problem from a monthly context perspective. Let's drop this thing down to a weekly timescale, and let's get on over to our good friend, the SPY, which is a little bit more familiar in terms of price levels. Obviously, the weekly bar does not look as compelling as what we just saw on the monthly chart. If we're thinking about the candle structure and location, and I'll do the same thing that we did last week so we can see that candle structure a little bit more cleanly. We've got ourselves a bearish inverted hammer here, where in the upper wick, we would clearly identify that sellers stepped up, right? They stepped up towards the highs and clearly pushed prices back down towards the opening print. However, because we have a green-bodied bar, they were unable to move back down to the opening print, never mind through it, for range expansion in the downward direction. So structure is more bearish. It does start to look a little bit more so like a failed breakout into blue sky territories, but it's not as bad as it could have been. You could still see here that we have a very clean bar-to-bar higher low as well as a higher high. We did end up closing back down underneath that breakout point though, which does side a little bit more so with the bears here. Nonetheless, just like the weekly timescale, I would ask and answer the question, do we have any threats of a weekly trend reversal yet? And to me, the answer is still no. This may be a little bit of a reversal signal based on the upper wick. However, it's not an outright trend reversal. This is still a higher high in the trend count. And if we pull back, we can afford a weekly higher low. Generally, you know, I know it's uncomfortable, but somewhere all the way back down to these upper wicks of the red-bodied bars here, that would be fine. I know in the past we've also been talking about this, which is the top end of the previous balance from the end of 2025 into the early February breakdown of this year. That's a-okay because we have not flipped into a daily downtrend. This is a soft higher low. So we would absolutely flip into a daily downtrend to navigate here at this point in time, and therefore Is it possible that that steps up as a firm weekly high or low? I think the answer is yes in terms of counting trend here. We could check in on our Fibonacci's, although not much has changed. If we come in from there, the bottom of this move to the top, you could see that the 38.2 is now just a hair above, of course, this previous all-time high test. This would align with the Fib 50% retracement. However, if we come in here with our anchored VWAPs on the weekly time scale, doing something that looks like this, let's get an auto zoom back in here, you can see we're above the entirety of the stack. And if we do something that looks like that, the anchored VWAP that's associated with the gap up from the China deal to make a deal move, you could see is loosely associated with the previous all-time high as well. So once again, on the higher time frame charts here, I'm not really seeing any indications of a major trend reversal, rather just the possibility of a pullback. We can finalize the weekly chart with our volume profile here, then we'll move on down to the dailies and see exactly what's going on. Where did we land relative to this high volume node? You could see that it still has not been violated. So although yes, we have an upper wick last week, it's not really enough to start breaking down substantially underneath high volume nodes on the weekly. Let's drop this down to the daily time scale and see exactly what's going on here. Let's begin with this week's expected move, of course. It will be a shortened holiday trading week. Don't expect markets to be open on Monday. For Labor Day, people are enjoying the last bits of summer. Expected move is here. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number is at 653.71, implying a brand new all-time high and a higher high in the trend count. That is bullish. And if we're contained by the lower bound at 636.39, it's a very nuanced higher low from here to here. I honestly would not be fond of testing the full lower bound. I would more so really like to see, if the market does pull back more aggressively, a higher low on the daily time scale exists somewhere over 638.15, due to the fact that if we were to take that out, we would be back inside of this inside bar consolidation into the end of, what preceded basically the Jackson Hole speech from Powell, where the market took off like a rocket ship in the upward direction. So we'd be giving back the origin of that breakout basically if we were to fail 638.15, which is why, once again, that's sort of my line in the sand for a daily high or low. And if you're counting trend, let's just go through it together. Lows, firm higher lows, we did achieve an hourly downtrend here. We're beginning an hourly downtrend, and we'll see this in just a moment. And it's possible, right? The pattern that everybody's going to start pointing to is possibly some sort of head and shoulders here. I think we could all identify that, of course, under the neckline at 642.20 is likely where that breakdown could take place for the thin structure retracement through the Powell move back down towards that 638.15. So if the daily chart is going to pull back and offer that higher low, this is likely how we would navigate towards that area. Of course, just a straight shot lower earlier on in the week is totally possible as well. Then I would put my thinking cap on to say, do we see buyers starting to step up at something like 638.15? Or if that fails, let's buckle up and be prepared for a daily trend reversal, some sort of equal low being made on the daily time scale here. Any rally attempts that then offer a lower high give you your larger head and shoulders as follows, and then maybe the daily trend reverses once we actually bring in some sort of lower low, which would be underneath 634. So if we're trying to navigate the possibility of a weekly pullback, again, we do have that inverted hammer on the weekly chart, the monthly trend remains up, we can afford pullbacks on those higher time frames, but we would need the daily trend to flip down. And once again, that's a potential path as to how that happens. You need to make some sort of equal low, 634, we'll go through it one more time, set some kind of lower high, and then get back down to the equal low. When and if you break that and bring in a lower low, the daily trend will have flipped down. Obviously, an alternative here is just that the market goes straight through 634 and automatically brings in some kind of lower low, and there is no response from buyers at this level, 634. That would not be my primary base case. I would not look for just a hot knife through butter style look here, noting that we are still getting quite a substantial sector rotation, which we'll talk more about when we get into the supporting evidence categories on the chart. In terms of what happened on Friday, there was this little lower wick that developed off of the potential neckline for the shorter time scale head and shoulders here. So it really becomes all about early in this upcoming week. Is the market spooked by what it gets over the weekend with the whole tariff uncertainty, or does the market shrug it off and really start to accept more so back above 645.25? If that's the case, then we really just have bull flag consolidation over the previous all-time high pivot from back here, and then we would be seeking upside continuation to continue alignment across the time frames, the bullish uptrends I'm referring to, over the all-time high at 649. So in my view, this actually probably is more of the base case, or at least some sort of neutrality up here as we potentially come into the September seasonality. I would say that the breakdown here and aggression to the downside would be a back pocket situation. This is not the primary outcome that I would be seeking, again, considering some of the data points that we'll cover here moving forward. Let's take a look at the hourly time scale and get a little bit more granular here in terms of what happened into the end of the week. So one thing that's very noteworthy is on the Thursday session, as we were breaking out towards those new all-time highs, we did repair the overnight all-time high that was left unrepaired from this Jerome Powell sort of overnight headed into the Monday session there. And then there was even an overnight high from back here that needed repair on the futures. That stuff has been cleaned up, and there is now no new overnight all-time high that needs repair. So this is an excess high in the regular trading hours session, and you'll notice that on the Friday open, we actually left a bunch of overhead supply. That was value area to the upside on Thursday, basically, where 70% of the volume transactions took place. We opened underneath that on the Friday session. So as long as those traders are trapped overhead supply, I would tend to think Friday's breakdown is shaking out some of the longs late to the party. Now, of course, as we mentioned on the daily, we could all start to envision how this develops your head and shoulders, but I think it's also very clear that if the market were to recapture this 645.25 on the upside, I really would not maintain any sort of bearish stance here on the market. Why? Because the hourly trend remains somewhat in the upward direction. We have lows, higher lows, higher low. This could certainly be seen as an hourly higher low. I wouldn't love it because, of course, from here to here, you get that lower low style look. But if you can recapture this, right, and produce the higher low back above 645.25, there's nothing here. There's nothing here in terms of thin structure retracement. I would imagine that the equal high should become the primary target, noting that your risk reward or the general range that we're trying to exploit looks something along these lines here. So over 645.25 early in the week, I would put my bull hat back on and I would start looking for some of these nuanced levels to be recaptured to navigate back up to the all-time high. Obviously through that blue sky territories, and we're just looking for upside continuation. If the market consolidates, and let's just say that we look above and fail on Monday, we consolidate in here, I'm not really thrilled about trading shorts inside of this range, noting what we had from back over here, some of the action that we had in here, especially into the end of day on Friday as Wall Street takes off and goes, for their last hurrah over the weekend. I mean, consolidation in here is inherently bearish for the hourly time scale, but I would only start trading the short side outcomes should we get breakdowns underneath 642.20, noting that we have this thin structure from the Jackson Hole speech to retrace, and that's how we ultimately achieve that 638.15. So the bear flag consolidation here leaves me open-minded to some potential downside early on in the week, but if we invalidate that via that 645.25 recapture, I think we're headed back up towards the all-time high, and the rotation thesis really remains in effect, where financials are likely to fuel the market higher. Financials are sitting on an all-time high. We'll go look at that in just a moment when we get into our sector watch. So that's really it on the hourly analysis here. Again, it's all about 645.25, 642.20, and then down here 638.15. Those would be the major levels that I would want to see resolution of in the upcoming week's worth of trade to help navigate what's going on with the higher time frame trends, monthly, weekly, daily, and of course everything stems down from the smaller time frame here on the hourly. We can come in here with some Fibonacci's from the bottom of the move up to the all-time high, just recognizing that your pullback technically on Friday went right to the fib 38.2. I would just say that this mostly aligns with the idea that staying over 642.20 generally isn't all that bearish on the higher timescales, right? You still have the opportunity clearly for a daily higher low. If you start to drop that, you're losing your picture perfect bull flag consolidation from that fib perspective. We can come in here with our intraday anchored view apps as well. And what I want us to focus on is just the confluence here from these anchored view apps. This is from the low as well as the origin of the breakdown here, right? That's reinforcing 642.20. And then if we anchor a view app to the day where we made the brand new all-time high, as well as the Jerome Powell Jackson Hole speech, you'll notice that right here, obviously that's your rock in a hard place between 645.25 and 642.20. All right, so that is picture perfect in terms of confluences out of our supporting evidence. Let's jump into our market internals. If you're not familiar with the market internals, check out the video tutorial in the top right-hand corner. What do we see here on the breakdown on Friday? This is paramount. Volume flows are technically up. In terms of the advanced decline line, we do not have a big trend lower zone read. We're not stuck down here in negative 1500 to negative 2000. So once again, when I say that the primary base case should not be seeking some major daily blow through of this level down here, 634 for some kind of lower low to immediately be produced, the reason for that is because the rotation thesis is still so strong. Look at the volume, look at the advanced decline line. The cumulative build only really got bad into the afternoon there because of the way that the morning session did not really build out a positive print. Now, obviously, if you look at the actual move intraday on Friday, Was like, is this move here in the morning associated with, oh my God, everything is falling off of a cliff? Absolutely not. Again, that rotation is very much so alive. It was semiconductors, the main culprit, that produced the downside early in the session. Then beyond that, not much really happened. So internally, I'm not seeing a big panic move where everybody's selling everything as we head into the month of September. It's really isolated to semiconductors as of right now, and we'll see that in breadth as well. Let's jump on over to our market profile, and what we'll see here is the exact illustration I was just talking about on that Thursday session, with value being left overhead. So the open on Friday here leaves the point of control above, it leaves the all-time high as excess, and then we get this liquidation break. This is a B-shaped profile where we know that in the A period single prints, it's really just emotional panic-driven selling. It's not new money sellers aggressively just, hammering the market lower off the view app all day. It just didn't happen. So if that's emotional selling, not new money sellers really getting active, supported by what we just saw in the market internals in terms of breadth, volume flows, the advanced decline line, then I'm not really convinced that, again, we have this market that's ready to just collapse and go to zero. Now, of course, the volume and value did migrate lower on the Friday session. We have to talk about that, but you are getting a little bit of a 45-degree line here off the low. There's great excess in the C period low. If you really zoom in here on the low of the move, look at the contract taper. It's pretty darn good. I would have liked to see something like double digits or even single digits at the low, but relative to all this consolidation that was taking place above, really nice taper. And therefore, I think it would be very clear this is roughly the equivalent of that 642, 50 level we were just talking about on the Spiders cash. Anything that does this back to the upside likely just squeezes back through this low volume void, the breakdown, the thin structure that we had above us. So I'm not really seeing the argument for, once again, a huge sell side move. Now, of course, we have the tariff uncertainty, the volatility that could be here headed into the Tuesday session. I think that's something that we can navigate as we come into the open there on Tuesday, that is. But for the most part, what would I do on the futures? I would just say, okay, if we're over something like the low of that pullback from what would have been Tuesday, I really don't see an issue for a larger downside protracted move, right? You're just really building out more so what I would consider consolidation up here rather than anything else. So I'll be open-minded to further downside, but I would really have to see a breakdown if we just go back over to the Spiders chart underneath that 642.20. And therefore, that's my first call out for the thin structure overhead on the market profile actually would have aligned to 645.25, just to get the numbers straight, okay? That's what I've got for you in the Spiders Cash ETF. Let's do a similar style analysis over in the NASDAQ. We'll jump on up to the monthly timescales, and we will take a look from our top-down perspective here. Now, we're not going to go to the NDX. We won't do all the historical comparison, but what I will say is that the monthly bar for the NASDAQ side of the house is not looking so hot, and we've been talking about this here on the channel. Everybody's been talking about it, really, over the last couple of weeks, really. It's the massive divergence between the NASDAQ and the S&P. You can clearly see much more of a monthly inverted hammer, sellers stepping up in the highs, pushing prices back down towards the midpoint, I would argue, of the monthly range here. Certainly not underneath the opening print. We still have a green-bodied bar. It's not as bad as it could have been. You could certainly see on the bar-to-bar count higher low as well as a higher high. Close, though, is back inside of the previous month's range. So that's a little bit of a failure to go higher pattern here on the monthly. I would still make the same argument as the S&P, though, where this is your last major higher low. I mean, is it possible that you could set some kind of higher low here, some kind of higher low? Of course it is, right? So there's plenty of pullback opportunity available on the NASDAQ without really flipping the trend to down. Let's take a look at the weekly time scale, which is, of course, going to be different than the S&P as well. We'll get a little bit of a closer zoom going on here. Very similar, perfect. So much more of a gravestone doji is what some people like to call this one. I would just call it a doji. Call it whatever you want, but inverted hammer doji inside, closing back inside of the previous candle's range. Sellers clearly stepping up off the highs, pushing prices back down, literally to close at the opening print. No weekly performance change on the NASDAQ. It isn't close underneath the previous week's close, which would have been the red part of the body of the prior hammer candle. You could see also that there was no attempted break over the hammer high. So there was no attempt to get trend continuation in the upward direction, and so far, this inverted hammer on the weekly has really indicated the top in the short term. Now, like the S&P 500, we don't really have a daily downtrend, so I would be hard-pressed to call this a weekly high or low. I would still be of the mindset that a weekly chart that pulls back here could easily set a higher low in the grand scheme of things and continue the trend in the upward direction. That would align with what we just saw on the monthly chart as well, and that would be confluence with your previous all-time high, closer to about 540. If we're thinking about what's going on with our supporting evidence body for the weekly, that's going to be our anchored view apps Fibonacci's and the whole 9 yards, we're still above the entirety of the stack. So are we really all that bearish, even though the chart is clearly slowing down? I would say that there's a momentum slowdown, but it's definitely not a bearish trend reversal just yet. I mean, you'd have to break a number of these reference points before I would get, overly bearish and actually seek substantial downside action on the higher time frames. If we look at the fib from the low of the move higher, so the low of this, the China gap up basically, we're above the 38.2, once again classifying all of this as bull flag consolidation, ultimately seeking upside over time. Another indication that's just not really all that bearish. If we check in on the weekly volume profile, it's funny what happens when your brain combines words as you're trying to say them. High volume node is where? Right about here. We did close underneath that. Again, a little subtle divergence from the S&P 500. Not the end of the world, noting that we're still in this high volume chunk, if you will. I would say things start to get a little bit dangerous if we break down underneath the previous all-time high. Does that align with what we were just saying anyhow about the NASDAQ and the possibility of a pullback? Of course it does, right? If we were to fall back down and really gravitate towards this high volume node and find acceptance there, we would inherently be underneath the previous all-time high. That would be a red flag on the higher time frames. We're not there yet. It's something that we could probably start to be a little bit more mindful of in the NASDAQ given some of this slowdown in momentum, but I wouldn't try to front run the idea of the weekly trend changing to down yet. Let's jump on into our daily chart. Let's check in on our weekly expected move for the NASDAQ and see what's going on here. So expected move gray box, the upper bound is at 581.07. It is a higher high relative to the pivot of last week, but it is a lower high relative to the all-time high. If we look at the lows, it's an equal low to what we had from the breakdown ahead of Jackson Hole. So all things considered, I'd be much more neutral on the NASDAQ weekly expected move, which I think rightfully so makes sense given that we know, and again, everybody and their sisters, brothers, mothers, goldfish is talking about this pattern. Nobody's really special for calling it out. It's really how we execute around it. There's your head and shoulders, right? Is this lower high going to confidently change the trend back to down in the NASDAQ daily timescale? I think it's possible. And the reason I would say that is because on the Thursday session, we had a breakout here over what was a multi-day range, right? Monday, Tuesday, Wednesday, 3-day balance range. Thursday breaks out, and Friday reverses all the way back down to the bottom end of that range. And again, this is also a rejection of this pullback low from here before the breakdown really accelerated on what would have been Tuesday of now 2 weeks ago. So the fact that we're rejecting the origin of the breakdown, the fact that we're not catching ourselves for a higher low here at 573.85 is absolutely more concerning in the NASDAQ versus the S&P 500. And of course, you can see the close underneath the daily 20 SMA. That's the orange moving average on the screen. And therefore, again, I don't want to say it's game over quite yet, but buyers are absolutely not doing what they should be doing if we're trying to progress this trend to navigate back up towards the all-time high to facilitate some sort of catch-up trade in the NASDAQ to the S&P. So for that reason, in this box, I have to maintain a bearish to neutral stance instead of the just straight neutral stance we had back here before the breakout occurred. Now that this looks a little bit like a failed breakout, I would have a bearish to neutral stance in this range. If we break the range, I would easily expect 566.50, and that is where things get ugly on the daily timescale. If you can hold it, fine. You persist a daily higher low, and maybe the trend remains in some sort of neutral state where we're battling a higher low versus a lower high. But I certainly would not be feeling good after this failed breakout here. If we were to sort of recover from this back into the range, I would have to just say that the daily trend is in compression. There is no daily trend, it's neutral. Okay, so this is kind of like, let's just take this step by step. Let's not overcommit to one potential side. I think that you could lean into the higher time frame narratives. Monthly, weekly is still bullish there, but I would not overcommit on the daily. If we break underneath 566.50, let's say that we get something that looks like this, then the head and shoulders is game on. And of course, the break underneath this low here brings in or ushers in a lower low on the daily time scale. That would be underneath your daily 50 SMA. That would be underneath the key line in the sand I would use is 560.25. 560.25 is the number to watch on the downside should we get the progression of the trend after the lower high here back down to the equal low at the move from the pre-Powell bottom. Okay, so that's the downside. If it's going to be much more optimistic, if all of this sort of like preparation and just understanding where the inflection points are to the downside is for nothing, then that's fine. The long-term accounts will, of course, rejoice in this. But where do we actually participate back to the upside? I would say any consolidation in here that invalidates the bear thesis again by moving over this level, 573.85, is probably not a long in this little box here, but rather this would be the long where I would like to get a little bit more involved over 576.50. If we could see something that looks like that, fine, no problem. You're technically invalidating the lower high that was set on Thursday, and that feels a little bit more confident trying to navigate back up towards the all-time high at 582.80. Let's drop this down to the hourly chart. Let's see what we can see from this perspective. You can see there's just utter failure, complete overhead supply here, rejecting. This was a healthy, controlled pullback, right? In this sort of zone back over here, this is where the momentum really picked up. So the fact that this is rejecting is fairly concerning, and again, this is why we're taking that bearish to neutral stance first. If we're getting consolidation in here, there's the stance. I would say there might be a scalp for quick draw McGraw underneath 569.25 to 566.50. This is where things become more compelling to the downside, as we know. That's targeting these equal lows here. That's that 560.25 spot. That's the daily trend reversal. If we get some kind of move that looks like this, I would generally be kind of neutral through here, and I would really get back on the bull side of the horse if we were to get this high or low back over 576.50. Right inside of this range, I think it's very difficult to parse out a trade other than just the ping pong back and forth in the range. If you've been doing well this past week, as we were in the range, keep doing what you're doing. But if you've been, like if you've traded this range and you look back at your P&L, your performance, you're like, my God, I did 500 trades in the NQ futures and I came out scratch. I lost on commissions maybe. Just like take it easy in the balance range, right? Wait for some price action over 573.85 at minimum or under 569.25 at minimum. We'll see where we go from there. Let's take a look at our anchored VWAPs on the intraday. You can see they're all converging towards this range. Right? All converging towards the range means that there's probably not much of an edge in here when everybody's just kind of like, all right, we're doing okay, right? Longs are kind of content from the lows in here. Sellers kind of content from the high over here, even from this high or the rally on the Powell speech, right? So not much action in terms of imbalance that you get between the two key levels, reinforcing that perfectly. Let's come in here with a fib, though, from two different perspectives. We'll come from the high to the pullback low, noting that we're in no man's land. So the balance range almost perfectly aligns with the fib 61.8 and the 38.2. If we're in no man's land, you really don't have an edge. Once again, if you've been getting chopped up in this range, just reassess, identify you're in a range, and either adapt your strategy or just don't trade that range. Right? The other Fibonacci perspective that we probably want to check in on is from the low up to the high here. The pullback is starting to violate underneath the fib 38.2. Not really great in terms of looking for straight up follow through to the upside. And I think that noting the 61.8 is confluence with the 566.50 just reinforced the idea that being short into the level, if you're still above, unless you catch the quick draw McGraw trade, this is not a place to be short into. It's a place to watch for the breakdown and then position short when and if we're getting acceptance underneath from the sell side at 566.50. Right? So this is a very long-winded way. I'm sure I'm going to get, tons of people in the comment section. It can go up, down, sideways. Great. Thanks, dude. Thanks for the analysis. Well, unfortunately, when you're in range compression, quite literally, in the NASDAQ, with the possibility of a higher low after a lower high, that's exactly right. So if you're trading, and like the actionable takeaway here, right, is to understand that inside of this balance range, the trend traders do not have an edge. And if you're a trend trader like myself, then we just want to be extra cautious in that range. If you're a balance trader, then rejoice. Keep doing what works for you. Okay, that is the nasty NASDAQ in a nutshell on the hourly. Let's take a look at the NQ or the NASDAQ side of the market internals. You can see here that it's a little bit worse, not a shocker considering the sort of negative divergence with the more sell side pressure we're seeing in terms of the daily trend. It makes total sense that you would see a weaker market internals dashboard versus the NYSE. So this aligns with what we're seeing. There's no secret hidden divergence. I would say the rotation theme is much stronger for the S&P. So if you're looking for something longer term, the S&P is probably the place to rotate into, not necessarily the tech market. Let's just give that the refresh apparently that it's asking for and jump into the NQ. Let's see what we have out of the futures. Very similar in terms of the B-shaped profile. So the look of the profile is very similar. You opened right at the bottom edge, basically, of the value area. So trapped overhead supply failing the breakout on Thursday. It would just indicate to me that if you are underneath the top end of that range we were just talking about, there's really not much to say in terms of a dramatic bullish edge. I would not try bottom fishing. And again, this is me speaking from a trend trader's perspective. I would not try bottom fishing off of the low end of the range, noting that we have trapped overhead supply here. I would let the market resolve this box and see what happens over or under the bottom end or the top end of the range. Let's go back on over to the platform. Let's finish up the broad market indices with the IWM Russell 2000 small caps, everybody's least favorite index, apparently. it's been an interesting one recently. If we go out to the monthly timescale, we're going to see a whole heck of a lot of outperformance here. Look at the magnitude of the green-bodied bar for the month of August. Solid green-bodied bar, of course, on the prospect that some rate cuts will be happening sooner rather than later. If we're thinking about the candle structure, solid green-bodied bar, strong close, almost a bullish engulfer. We technically made a new low, but closed on this massive new higher high relative to the previous bar. Of course, still not a new all-time high here. We are still lagging the market, more broadly speaking, in small caps. However, off the lows, dramatic outperformance for sure. In terms of a monthly higher low, the key level that we would need to see hold up, at this point, I would argue for this right around in here. You really wouldn't want to take back more than the August bar. Sure, you could hypothetically find a higher low relative to the April tariff lows, but considering the movement that's been made thus far, you probably don't want to fall back down underneath what we've been considering on the weekly chart, head and shoulders neckline from in here. So speaking of the weekly, let's go there now. Let's take a quick glance. There it is, by the way. There's that head and shoulders we were just talking about. There's that support. So you wouldn't want to take out the lows of August here. More importantly, though, on the weekly, just notice that we do have a indecisive doji at the highs. I would just pose the question, is the weekly trend up? The answer, of course, is yes. Lows, plenty of room for higher low. And this is the highest high in the trend count, measuring from, of course, the April lows. Where would we want to see the higher low on the weekly? Of course, over the top end of the prior range, which is much closer to about 225. We've been talking about this balance for quite some time in the Russell. So the weekly chart looks just fine. Let's come in here with the Fibonacci, see if it aligns with that potential move. Yep, well above a Fib 38.2, no issues from that perspective. And coming in like that, Fib 38.2, spot on, right with the top end of the balance range as well. The last Fib we'll pull is from the high down to the low here, just to reinforce that once again, we probably don't want to fall underneath this level on the higher time frames. Otherwise, we lose the Fib 61.8. And as we know, the more bars we can close over the Fib 61.8, the higher the likelihood of the full 100% retracement over time. So far, buyers are sort of batting 1,000 here on the weekly and monthly. Let's check in on those anchored view apps. From the small caps perspective, the entirety of the stack is underneath us. Probably should start anchoring one to this day, or this week, I should say here. That's 728.25. Just for the sake of a quick exploration, let's do that. That is going to be at 20.25, 07, and then 28 was the week. There we go. Let's check in. And obviously we're well above, but what I care about is the confluence here over the top end of the balance range. Looks pretty darn good at this point from the weekly perspective. Let's go down to the daily chart here for small caps. And let's see what we can see from this point of view. Firstly, evaluating, of course, the weekly expected move, blue box or gray box with blue bounds here. We've got 240.22 on the upper bound, higher high in the trend count, and the lower bound is here at 230.12. I would still argue that's a major higher low in the daily trend, right? We have lows, higher lows, higher lows. We flipped into an hourly downtrend here. This was a soft higher low, really. It's possible that flipping into an hourly downtrend still could yield a higher low over 228.65. The weekly line in the sand was this one here, the balance range highs at 225.50 that we were just talking about. So if the market were to pull back in small caps, it would probably require a breakdown underneath 232.85. Should that take place, 228.65 is then where I would look for that higher low, and this would be bullish generally for the S&P 500. Sure, intra-week, you're probably going to get pullback that aligns in the S&P if this breakdown were to take place, but if the small caps hold in here, it continues to reinforce the notion that the broad market rally is quite literally broadening out into some of the smaller companies, not just the tech-dominated, NVIDIA's, Microsoft, Apple, the Mag 7s of the world, basically, right? So that's that. On the upside, clearly a two-day high in here. If it broken at 237, I would expect some upside. Previous historical levels at 239.10, upper edge of the weekly expected move, and then 240.230 on the upside should we get that continuation for the trend in the upward direction. It's as simple as that. Let's take a look at the hourly chart. Let's see what's going on from this point of view. One thing I do find very compelling is just the precision around this 235.15. If the market accepts underneath that early on in the week, maybe we put our pullback hat on, just noting that we have a little bit of this man ray pattern happening over here. Of course, that's trademarked, registered, copywritten, the whole 9 yards. Don't try to steal it. The lawyers will be after you. So 235.15. Should we reject and stay below? The pullback is certainly reasonable. As we talked about on the daily, it's a great spot here for a potential higher low, which would be bullish for the S&P 500. If we fail that area, I would really expect more so some kind of consolidation phase, and I would just monitor that 225.50 from the weekly perspective to see if we do maintain the ideal higher time frame pullback. If the market were to accept here, I think it's just a pressure cooker top over 237 to, of course, get the break and follow through in the upward direction. Very simple levels here on the IWM. I would not overcomplicate this chart by any stretch of the imagination. So let's keep it moving then and get into the Russell internals. What do we see? Really not all that bad in terms of volume flows here. A little bit of a weaker close than the S&P, and the cumulative build on the tick is very similar to the S&P. Not a major, again, if we're thinking about the size or magnitude of the sell side pressure during the pullback on Friday, this does not look like, oh my God, let's sell everything. It's a panic move and we just got to unload it all. It really looks more so like either profit taking, mild sell side activity, maybe some momentum sellers stepping up in terms of trades, but not new money sellers really getting involved. If we take a look over at the market profile for the Rusty Russell, and we'll just put this with enough data on screen, something that looks like that should be good. What I would just call out here is the extremely poor low. There is no excess. We saw great excess on the ES, great excess on the NQ, no excess low here in the Rusty Russell. So therefore, if this is susceptible, it wouldn't be unreasonable for the Russell to sweep that low, test the bottom portion of its consolidation, and then try to figure things out. So if we just go back on over to the IWM, right, seeing that this is that poor low, again, would not be crazy to sweep it, consolidate in here, and then try to make a decision as the week unfolds around 235.15 and 232.85. Do we recapture and maintain bullish, or do we pull back here and then start the deeper pullback, which of course would influence as a headwind the S&P 500. That's what I'll be looking for in the small caps. Let's get back on over to the primary index and let's take a look through our sectors and see exactly what's going on from this perspective. So it's a rotational market. We know that. Who was leading, who was losing, and where was the weight this week? We have 2.81% leader coming from energy. Then we get financials up about 97 basis points, followed by materials and then communications. At the bottom end of the barrel, it's utilities. Then we see staples. Then we see semiconductors. So overall, not the greatest performance from the semiconductors post NVIDIA earnings. At one point during the week, really into Thursday's close, semiconductors were outperforming on the week, and now not so much the case given that Friday pullback. However, if you look at the worst offenders in terms of weekly performance, it's still defensive, right? It's your utilities, it's your staples. If you look at the outperformer, energy, it's not really defensive per se. It might be a little inflationary perhaps, and we'll take a look at that, of course, as the show wears on. But financials, we have to remember, are the second heaviest weight sector by market cap. This is a bullish and risk-on sector for the market overall, especially if you're a believer that financial innovations over the coming years, perhaps, will further to bolster the financials weight in the S&P as an index itself. So generally, I can't look at this posture and say, oh my goodness, the market's doomed. It's just not the case, right? And especially noting that on that Thursday session, I can't go back and unfortunately show you the performance there, but on Thursday, the outperformers of the session were the heavier weight risk-on sectors as well, individually. So I'm not overly concerned with this pullback. And again, in the S&P 500 in particular, the rotation thesis is what's keeping me open-minded for continuation of the higher time frame trends. Of course, that doesn't exist quite as much in the NASDAQ, which is why I would be slightly more cautious of that, not sector, but that market, really. If you take a look at the energy sector breaking out here in the upward direction, trying to navigate through the gap, upward pressure is upward pressure for the market. If we look at financials, chart looks fantastic. Brand new all-time highs, beautiful high and tight consolidation. You're getting a little bit of an upper wick here on the Friday session, but nothing that I don't think has the offering, perhaps, of another higher low. Either you consolidate here and get continuation, straight up continuation, or if you pull back here, I would still maintain a bullish stance so long as we're over the moving average cluster of the 20 and the 50. If we look at materials, it looks primed for a breakout here. That, of course, would help us out on the cyclical side of the economy. With lower rates potentially in the pipeline, we'll see how the inflation and labor data comes out in the next week or two. Labor's this upcoming Friday, of course, but it looks primed for continuation in the upward direction, which would be bullish for markets overall. Unfortunately, it's the lightest weight sector, but in terms of spending in the economy, it certainly looks a little bit better as opposed to worse. If you look at communications, just consolidating sideways all week, basically. Not much to write home about. I think the key question here is just, okay, we didn't really do much, but does that automatically mean we're bearish? No, it's just high and tight consolidation, bullish digestion of this breakout from back here over pretty much all of the key reference points. If it breaks out, great. If it pulls back, also fine. Still would maintain a bullish stance in the XLC so long as we're over this. If it ends up being a double top, it would have to break the neckline at 108.50. Let's take a look at the real estate sector. Not much to talk about over here. Let's move along to the tech sector. Probably more to talk about. Of course, just like the QQQ there is your head and shoulders. Here's the possibility for that lower high. I'm not too fond of the breakdown back below 263.50 into the close of Friday. If you take a look at the hourly chart here, you can see all the consolidation late afternoon is underneath. So it starts to look more like a failed breakout, very similar, of course, to the S&P itself, but noting that this is the heaviest weight risk on sector, it's kind of unfortunate that as the S&P made that new all-time high, here's the outperformance on, of course, Thursday, it gave it all back and some, right? Falling back down basically to the consolidation lows here. I would be sort of not concerned in like an, oh my God, the market's going to crash and burn style way, but it seems more likely to me that the more time we spend underneath 263.50, it just leaves a lot of trapped overhead supply. It leaves some disappointment, a sour taste in the mouth of technology investors, basically, primarily due to NVIDIA and the pullback there. And I think that we're more so range bound. So like I traditionally say, it's not a head and shoulders until it is. You would need to break down underneath the neckline. You would need to actually bring in that lower low for me to become overly concerned. There we go. That's going to be at 256.50. We'll watch it. I think that's going to be a primary watch as we head into the next, really the month of September, right? We know that seasonally September doesn't perform as well. If the tech side of the marketplace starts to break down here for a larger pullback, I mean, in the grand scheme of things, we could afford weekly and monthly higher lows. We could clean up some of this gap structure. We could come in, we could retest some of these big major previous highs. That would be fine. But in the short term, of course, it will provide downward pressure in the S&P marketplace, right? So watching the tech sector very closely here as this rotation unfolds. Utilities, not much to talk about here. A little bit of a pullback back towards the previous all-time high would still maintain a bullish edge for the structural chart, but of course, it's lightweight for the market. I'm going to be watching staples very closely this week at 80. If they can continue to rebound, it's just a range trade here out of staples. Semiconductors are going to look very similar to the XLK, failing a pretty key level on that Friday session. Just like the XLK, it's not a head and shoulders until it is. You need to break the neckline, which is here. Oops, we want a rectangle, please, at the 283.20 spot, which is the previous all-time high, right? If I zoom way out on this, looks like we have to grab more time. Just as a reminder, right, this previous all-time high is the neckline. So if we're above that, on the weekly charts at least, I would be, stumbling over my words because I just would not change my tone to bearish if we're over that previous all-time high in the grand scheme of things. Now again, if we crack the neckline of the head and shoulders, if we break the weekly pivot, then of course I will change my tone when this happens. But until it happens, I don't think it's worth trying to front run that idea. It's just not. You're in a neutral range until proven otherwise. Lows equal lows, highs equal highs. There's no trend. There's no trend until proven otherwise. Moving along to industrials, it looks like we will not need that 5-year chart anymore. It looks okay. I would say be wary of the lower high opportunity happening here. I wouldn't really throw the towel in on the bull side until we dramatically break down underneath about 148.25. You could start to get a little bit cautious of that underneath 151.25. Let's move along to healthcare. The range just continues to do rangy things, balancing off the highs here, pulling back a little bit. I'd be curious to see if it does or does not close this gap before ultimately breaking out. If we don't go to the midpoint and close this gap, then we probably want to go with the XLF in the upward direction over this 138.75. And that could be seen as a little bit of a defensive rotation if this takes place through the month of September. But one thing I would just sort of, again, as a question pose, okay, if healthcare is, if healthcare is breaking out and lifting here through this range as the tech sector pulls back, is the S&P 500 going to crash and burn and go to zero if there is rotation happening in the sectors? The answer, in my view, is no, right? It may not be a risk-on sector, but it's going to prevent an Armageddon-style collapse where, oh my God, sell everything, nothing catches a bid. Now, just like we don't want to front-run the ideas of, let's say, semiconductors breaking the neckline, or same thing with tech, we don't want to front-run the idea of the XLV actually breaking out until it does. So we'll maintain sort of neutral stance until we're actually over 138.75 daily 200 with some kind of confidence, some kind of price acceptance here, then seeking the upside rotation. Moving along, XLY, chart looks fantastic. Nothing to complain about here. Pullbacks remain in play as long as we're over 227. So it's very hard for me to switch to this bearish stance even as we head into seasonally a terrible month. It just seems to me like there's more opportunity in select sectors and just knowing the instruments that you're trading. Nothing to talk about over here in the bond market. Really, it's so sideways, which to me is you try not to be surprised by the market, but considering all of the things that are going on with the administration, the Fed, and where we are in the cycle, I'm a little surprised that the TLT is as flat and sideways as it potentially is. So with that, let's jump into some ratio charts and see if we need to lean risk on, risk off, what's going on here. If you're not familiar with the ratio grid, check out the video tutorial in the top right-hand corner. A little bit of a concern here. This is nothing that we haven't already acknowledged out of the XLK structural chart. XLF is starting to perform quite well, actually, on a relative basis, making that new all-time high. Discretionary still looks very good, pulling back from the highest high in the count after recapturing this little look below and fail. Communications still look okay. So although tech might start to turn into the sore spot, it's very, the other sectors are performing quite well. If we look at the XLV, not quite risk off yet, nothing here out of staples and certainly nothing here out of utilities. So I cannot change my tone to risk off until these charts dramatically change trend. I would say the same thing here. We're getting some slowdown. A lot of these ratios use tech as the risk on component. You could see that there. You could see semiconductors here relative to healthcare. So some slowdown for sure, but until these trends actually break, this one's pretty pure, XLY, XLP. That looks really solid here as risk on. This is kind of drifting sideways. When and if a new low comes into this one, I'd be concerned. This still just kind of balanced over the daily 50. So we're right on the cusp of maybe having to flip into a little bit more of a defensive stance. But again, it just hasn't happened yet. I think that the main takeaway here is we might button up our expectations of massive relative outperformance from the tech side of the house and just say, okay, rotation might keep us a bit more neutral in the S&P, but it's not outright bearish. And I think that's really what I'm trying to convey through this video. It's not like we should be running for the hills and like, oh my God, it's, markets are going to break down. We'll change our tone when and if we have to, but the data in hand right now, not overly indicative of that. If we look at gold relative to the S&P, pretty big outperformance into the end of the week. Gold is actually starting to break out. We'll look at that underlying chart in a second, but the TLT ratio to the S&P, no flight to safety there. Bitcoin is breaking down. So let's go through a couple of these charts in their full glory. Let's go to gold first. Gold is starting to break out, right? If you take a look at this as maybe a little bit more of a pennant, something like that, you're breaking through the upper portion of the trend line into the Friday close. If you look at the GLD as a ETF, just let's go maximize here. There we go. Clean new high being broken in the GLD. Of course, this does have to do with a little bit of the tariffs and the potential walk back there. The legality of all that stuff. We'll see how that continues to perform, as well as the Lisa Cook issue with the Fed. So we'll see, but gold outperforming here, I think, has some legs. This is a very long period of consolidation. It has the right catalysts behind it to potentially really continue to push prices higher. So I would probably look to be a bull in gold over the next little bit, using the ETF over 315.75, using the contract here in the futures, you're probably talking about over 35, 30s an ounce if you can really start to accelerate there. What's the current contract on gold? Anybody know what I should probably just type and it will pull up. GC, do we need Z's? That's going to be December's contract. I think they have monthlies, though. I could probably just go to the trade tab here. Apologies for not doing my homework in advance. Goes to show you how frequently I do trade the gold contract, hardly ever. GC Z25, it is Z. There we go, GC. Let's go to the Z25 just to check in on the break level. Yeah, so it's still pretty accurate on the Z, unchanged there around 35, 37s. So you might bump that up slightly, 35, 40s. On GC for the futures. If you can break out through that, you've certainly got a massive coiled up gold market underneath you, probably looking for some upside. We'll watch to see where it goes. If you could pull into a higher low, that would be notable as well. So if you break out and pull into a higher low, you probably want to go with that breakout. If you break out and Brigade bolt above, that would be even more bullish, right? So getting out of this range on gold, probably worth continuing to watch for. That is that one. Let's talk about the digital gold, though, which is going to be over here on the Bitcoin chart. Obviously underperforming, and as a risk asset, because that's really what I see it as. I know that there's many arguments for or against that. Pretty picture perfect Brigade bolt lower high underneath the neckline of this double top. So the swing trade I was in on Bitcoin, for anybody who's been keeping tabs at home, stopped out here just a hair above break even, meaning like I would call it a scratch trade basically. Small sliver of green, now substantially lower. I think that this has to prove basically a new pattern before I would get bullish on Bitcoin again. And this has been one of the leading indicators, a little bit more so than the tech sector, that we're kind of pulling off of an exuberant risk-on marketplace, right? Just when everything was firing in the upward direction, Bitcoin had been lagging here for a little while. It was really the prompt failure at the all-time high that was, in my view, the stronger signal out of Bitcoin, just the fact that there was no acceleration through that. So now that Bitcoin is underneath the neckline in here around 13,850, 113,850 is what I would call it, I would just maintain a little bit more of a cautious stance through that. Now, of course, you could come in here and take a look at ETH, which of course is your Ethereum futures. You're getting a double top look, but you're not underneath the neckline yet. If this really starts to go, I think that it's more of an indication that we probably lean more towards the risk off side of things rather than risk on. So that was your B set. Let's get into the dollar and rates, which just like the TLT are going to be hardly changed, which is very surprising to me, but it's the reality of the market right now. Let's jump into the inverted ZT. Continuing to pull back here, just higher odds of a Fed cut come the September meeting, which is going to be on September 17th. Speaking of, let's just get on over to our Fed Watch tool here. The odds currently stand as is, 86.4% odds for a cut, and that's a 25 basis point cut. Jerome Powell seemed fairly open to that in the Jackson Hole speech, of course, which is why markets likely rallied. I think the only thing that derails these probabilities is poor economic data that comes out over the next 2 weeks. On Friday, we get the labor report, so let's just jump on into the calendar here. Let's take a look at the labor report lineup first. So, of course, Monday's market closed. Monday markets are closed. There we go. Tuesday we get ISM manufacturing PMI. That'll be interesting. JOLTS is the first taste of labor. I would say it's less about JOLTS here. We know that the beverage curve has been all out of whack. It's going to be all about the jobless claims and the unemployment rate down here that the Fed is likely concerned about. Remember that in the Jackson Hole speech, Jerome Powell was really talking about ways of measuring maximum employment that the economy could sustain. So we've had a fairly low unemployment rate. I mean, all things considered, this is historically low, right? So any uptick on that would be a concern for Jerome Powell and possibly put rate cuts more so into play. I think it's going to be a little bit less about the non-farm payroll number, in my view, and more about the actual rate. The PMI for services as well is going to be very influential for inflation on Thursday morning at the 10 o'clock timeframe, because services prices paid have been sort of climbing. If we just take a look at what happened last week relative to the PCE, the Fed's kind of caught between a rock and a hard place. You guys know this has been my view for a little while. I think the view is objective, but my subjective opinion is that if Powell cuts, personally, I think that that's going to be a little bit of a mistake. However, the data itself still shows us that PCE, the Fed's favored measure of inflation, I mean, it's a 2.9 headline number for the core PCE year over year. How can you say that's close to the Fed's target of 2%? I mean, maybe there's been some meaningful progress made in the downward direction if you look at where it was sort of coming from after the sickness up here at like 5.6. Yeah, we've made progress. But if the Fed's target is 2% and we're getting an upward trend here, again, thinking about perhaps, let's just go to PMI, let's say services, prices, paid, United States ISM services prices, there we go. This is the chart we want. This is coming out on Thursday. Prices paid tends to lead inflation, right? You can see how this peaks before inflation peaks. If I go back even further to a 10-year chart, you can see that this starts to accelerate here before the meaningful acceleration here in inflation. Your PCE is in blue, your prices paid are in gray. So you're already seeing the acceleration into what is already going to be an elevated PCE print. If on Thursday the number comes in hot, you're still developing this tension with the Fed. So it's a very interesting time to sort of be parsing this stuff out and figuring out what's going to happen. Obviously, we just want to continue to trade what the market is suggesting to us. We want to trade the levels in front of us on the charts. But inflation, like if, again, my subjective opinion is to be interjected here, I would think you're probably going to get higher inflation over the next little bit. The next couple of months, we'll see hot prints. It's just that's what the data here in front of me would suggest. That's my take. If you disagree, that's cool. You can let me know down below in the comments section. Anyways, earnings, let's talk about it. NVIDIA earnings were the highlight of the week, of course. They were not quite up to snuff with the market's expectations. However, something we haven't seen in quite a while is revisions in the upward direction for earnings here, EPS, through the end of, really Q3 is what this chart shows us, but even the end of the year there, fiscal 25. So information technologies is the leader here. What does that mean? That probably means that even with rates remaining somewhat elevated, your EPS is actively sort of justifying the higher price point in the S&P 500. One thing that you could look at here is if we scroll all the way down, apologies for all the crazy scrolling on the screen, but I know where I need to get. Let's come on down to this chart right over yonder. We're approaching quickly. Here it is. Let's start with this one. So your bottom up 1 year EPS for Q3, small upward tick there. You could see where the massive revision started to come in here, back in the upward direction. That's calendar year. And then if we jump into this, I want my, not calendar year, but quarter. There we go. If you recall, you can go back and find the videos here on the channel. Q2 of 25 was actually supposed to see another suppressed earnings read, right? So the fact that the market's coming in at higher than anticipated earnings, again, probably justifies without a big modification to the PE ratio. You can see it's really flat in here. It's not a multiple expansion. It's just that companies are actually producing more earnings, right? So that is the fundamental take, which might just say, like, who cares about what the Fed's doing? EPS are up. And, if the Fed's going to be more dovish, that's, if anything, going to act as a tailwind. Personally, I don't think that to be the case. Again, we've talked about the whole inflation dilemma, but I mean, you can see the PE, unchanged PE, EPS up. That's some actual improvement in the underlying fundamentals of what's happening here with the market. Let's jump into the earnings calendar for this week, though. I think it's going to be all about Zscaler for our cyber side of things. CRM is going to be interesting. Mark's going to have to pull some magic tricks out to help out the stock there. C3AI gets an honorable mention. I would say that's pretty much it before the heaviest hitter, Broadcom. Broadcom, of course, being the 6th heaviest weight company in the S&P these days, very responsible for a lot of the gain that we've seen recently, and could be equally as responsible for some of the pullback. Broadcom has been struggling recently and does have the opportunity to trigger a head and shoulders, which we'll talk about because it is in the core list of companies in just a moment. Honorable mention to Lulu, probably DocuSign here as well. And that's pretty much it for me as we come into the close of earnings season. And then it's honestly going to pick right back up before we know it with financials over the next couple of weeks here. Let's jump back over to the platform and let's take a look through our remainder of the supporting evidence. Let's start with the bond relationships. Again, it's not my opinion that inflation is going to come soaring back because I'm just some sort of jerk who wants to see high inflation. It's not the case. I'm just looking at the data. I'm looking at the ISM services prices paid, the correlation, and you can even see the bond market is quite concerned about this as well. If this breaks out, that would just be a clear signal from the bond market that the longer end of the curve is trying to do some of the heavier lifting to get ahead of the short end rate that the Fed is, able to manipulate. So if high end rates go up, what's that telling you about the expectations from the marketplace where people vote with quite literally billions of dollars, right? Not little trade brigade Matt and my opinion here. That's literal billions of dollars telling you that via the relationship. Let's come into the credit spreads and see what's happening here. Typically, this divergence resolves in favor of the S&P 500 remaining stable, but because we're actually getting a little bit more than just a day or two of divergence, you can see that you've made a more meaningful higher high here, as well as here on the LQD. This is corporate grade versus junk, which would be the underneath one here. So, investment grade, corporate grade versus junk. Just a little bit concerning, indicating that potentially that volatility for the month of September is going to show up. The divergence has not resolved. Again, if it is going to be favorable for the broad market, it tends to resolve quicker, sooner rather than later. If we look at junk bonds in isolation, they are technically moving higher up here. That's helpful. You can see that corporate grade really hasn't done anything on the LQD. If we jump into our breadth charts, you'll notice that breadth is fairly stagnant and sideways. So as we pull back on that Friday session, not the end of the world. I'd be much more concerned if this made a big print down here around 0 or below, negative, God forbid. And what does this sort of reinforce? I know all signs really point to the same thing. It's this rotation theme in the S&P 500. And if you haven't seen this or felt it intraday as you're trading, then you're just kind of either living under a rock or pigeonholed into trading one ticker, which is fine if it works for you, do your thing. But in terms of understanding the market right now, very, very rotational. Look at the RSP not making a new low there on the pullback from the Friday session, just remaining stuck in balance here. So I'd watch that very closely. The QQQE, of course, is a little bit more on par with this sideways consolidation near the lows, not making a new high up and over this spot. That makes sense considering all the things we've talked about with the tech weakness recently. Volatility, a little bit of an uptick here into Friday, but nothing where we should be writing home and saying, hey, buckle up, it's going to be the end of the world. VVIX, same thing, a little bit of an uptick there, but not much to really write home about. Vol futures still remain in a very strong contango. Money managers like this. Same thing out of the 9 versus the 30-day VIX and the 1-day VIX, small uptick here, but nothing meaningful in terms of breaking out over these highs at 1275. Let's jump back over to the platform or the main part of the platform. Let's take a look through the core list of companies and see what's going on. So the gist for the broad market. It's bullish until proven otherwise, but with respect for the possibility of some neutralization through the month of September, really. Not a bearish, oh my God, we're going to 0, but probably not as bullish as we were through the rally over the course of the summer. As we take a look at NVIDIA, obviously post-earnings, we are lower, and NVIDIA's sort of just turned into this range, right? NVIDIA's trading in this range, has not really done anything. There is no longer a daily trend on NVIDIA. We've lost the daily 20. I would say falling underneath this consolidation probably disappoints quite a few buyers. If we take a look at the hourly time scale, you could see that the overshoot on Thursday post earnings to close back inside, buyers could have held on to some semblance of like, okay, not so bad. But the big sell on Friday in terms of NVIDIA's relative movement here does take that out of play. You take out Thursday's low, of course, and you're just consolidating on some of these lows prior to the earnings report. So I find it very difficult to parse out a clean trade on NVIDIA and what the actual move is. This is kind of like no man's land. We don't have the cleanest structure in here. I think the best idea is like let it break down further and gauge the response at 170.30, or if it rallies, do we just reject 176.50? Do we just reject 179? These ideas are primarily what I would be focused on into the coming weeks worth of trade. If we do snap 170.30, understand that is a daily drift into a downtrend. Over time, I would think that some structural repair, this gap, there's many gaps back over here that are still unfilled as well from the lockout rally through the summer. I'm not trying to be like, oh my God, a big doomer and say we're going here. It's just if the trend flips to down, I would be much more open-minded to starting to navigate towards some of these downside targets. Okay, that's NVIDIA. I think that that could obviously have the power to bring and drag at the same time. Again, brain blending words. Drag the broad market lower, S&P, right? If you look at Microsoft, trying to hold in here at the last major high or low before the earnings gap up. As of right now, I think that this is sort of stuck in bear flag consolidation. Very ugly charts in terms of the intraday in here. If you take a look, notice how just sort of like big upper wick, no follow through, and then a grind. Sideways consolidate, like just very, very sloppy through some of this prior stuff. I think you could easily get some sort of continued bearish progression underneath 506, and then the breakdown would be some sort of lower high acceptance below 502.25. Consolidation up here. I'd be interested in this trade as a potential long. So it's got to resolve this box. That's really what it needs to do. Over 511.25, counter trend trade continues to 518.50. Please reevaluate for a lower high. You could see it clear as day on the daily, literally. There you go, right? Retest of the origin of the breakdown. If we get the move lower, right, you're just thinking about how do we navigate ultimately to the last set of higher lows from the hourly pullback, which would be 490. Let's continue along to Apple, another chart that I'm, like Microsoft, not overly thrilled about trading it. I would say that bullish holds over 230 could yield like sort of a higher low relative to this place. Obviously, this is a higher low as well in the trend count. Your next big bullish trade is just going to be a break over 235.75. You're getting a decent amount of digestion through this prior junky range, I would call it, over on Apple. You know, there's no clean price action here. A new catalyst would really be ideal to get this kind of move in there. I have no idea what that may or may not be, but that's kind of the way I would view this chart. Do we get the upside happening there, or does Apple just continue to grind around? Okay, I would not really be interested in trading it in this sort of pivot zone. I'd really just let Apple be. Not Applebee's, but Apple B. Let's take a look at Amazon. Amazon looks decent for the potential over 235.50. Not the best close on Friday, but if this consolidation can persist, we know that the XLY as a sector looks okay right now. This is one of the heaviest weight components. Over 232.50, 236.25 becomes the compelling idea. Lows, higher lows, right? If not, and we start to break down in here, I would be a little less interested in trying to trade it back down towards the moving average cluster, noting that you'd just be in range compression at that point, right? You're getting something that would look like this, and who knows? You just drift, do you bounce, do you chop, do you do whatever? Not really compelling, and you can see it here on the hourly, right? I suppose in here, perhaps, call it head and shoulders. You have your neckline. I wouldn't be trading short into this unless it's a quick draw McGraw scalp under 227 into 224.75. Right? Quick scalp, what goes straight up, came straight back down over here. Maybe it comes straight back down. That was not the case in this breakdown there. And then I would reevaluate. I would reevaluate at the midpoint of the range and see what's next for Nancy. We don't want to skip Google. Let's go back to a daily chart. Great new all-time highs. Great relative strength on Google recently. I would continue to maintain the bullish stance here on Google. So the name of the game in terms of the hourly becomes how do we navigate a potential entry? If you get consolidation here, simple Brigade bolt over all-time highs, the hourly level 213.70, blue sky territories. If you get consolidation here, of course, head and shoulders, as we can all see, under the neckline, I would start looking for higher lows around this spot, right? Or heck, if Google just puts in support here, it's going to then start facilitating the potential for this move here. Right? So if you hold this and do not break down for the head and shoulders, that would give you bullish confidence as well that you want to go with the move over the previous all-time high, 213.70. Where would I become more bearish on Google? Probably if we get back down to this level, producing an equal low on the daily time scale. If this is the last higher low in the trend count, an equal low back down here would become concerning at 206.15. All right, that's where I would reevaluate my stance on how bullish I am in Google. Let's take a look at the metaverse. Let's go daily chart first, actually. So lower high starting to show up a little bit more cleanly underneath the daily 20, we are ultimately back down underneath the previous all-time high, which of course represented the low of what remained from the earnings gap from back here. Consolidation there likely seeks continuation through the gap. If we do get a move back above, I think you have a double bottom in force here, and pending any sort of Zuckerberg AI infrastructure build out and new news from Meta, I would think over 756 becomes compelling back to the long side. So bears definitely have the edge first, noting that if this was going to be some kind of higher low double bottom, you ideally would have wanted to just stay up here on Friday, then do this early in the week, retracing the thin structure. Not the case. This is bearish consolidation. So the first thought is that this is a lower high on the daily, equal lows. Should you break under 734, you've got that big gap to close underneath. A couple of little inflection points in there. You've got 726.75, 719.75, 713.75. Then the full gap close at 708.25. Let's take a look over at Tesla. Tesla's becoming a little bit difficult to navigate on the daily in terms of the trend here. You do still have lows, higher lows, higher lows, higher lows. It's possible if you support the moving average cluster, it's an arbitrary higher low. It's not really a clean hold of this previous high. It's not really a clean hold of this breakout point. A little sloppy, but undoubtedly you could build the argument that yes, this ultimately is some kind of upward trending channel in here. So daily leaves a little bit to be desired. The hourly chart is interesting because of its thin structure. My primary ideas on Tesla would just be if this rally and rejects this 338.85, I'd be fairly concerned about continued downside and the potential for a non-higher low. The other thing that is or was abundantly clear on the Friday session was that Elon was, pretty active on X. You could go check his account out for what was going on with Friday. And participants don't like that when Elon is tweeting things that have nothing to do with his companies, and rather he starts to get involved in politics globally. So if that continues to be the case, I would suspect lower. But as we know, if we think back to when was Elon going off the rails about the administration and the files, the Epstein files. Can I even say that on YouTube? It was back here, right? So I believe it was back here. Must have been. So when that was taking place, it quickly rebounded. So all it's going to take is stop posting on X so much, and let's see if we can get back over 338.85. If that lower high is going to be negated, so I guess the idea would be if we get back to here with consolidation, then it's actually just thin structure back to the upside to retrace to the origin of the breakdown. Now, of course, there's some other headlines swirling around out there. Let's not be oblivious to the fact that in Europe, sales, I think, were down 40%, or market share was down 40%. There's some metric that was down 40% based on BYD, the Chinese competitor, sort of taking up more of the slack, so to speak. So it's not just the X thing. There's other company-specific headlines to be mindful of, but that's sort of the way I see Tesla right now. The daily trend, not too compelling. The hourly, you've really got to navigate this with grace and tact, and you have to watch your stops very closely and trade it responsibly intraday. That's been the most lucrative way to approach Tesla over the last couple of months, really. That is what we've got on Tessie. Let's take a look at JPM. JP Morgan, financial sector, looks great, new high. If it pulls back, support here for a higher low over 294.80, looks good, seeking upside. If we jump on into Palantir, there's not much to say inside of this range. I think the best trades come from this. The best trades come from this. The only trade I would sort of be interested in as a range rotation is over the midpoint of the range. You have back-to-back hammers, low, low on Friday. If you could take that hammer high out with acceptance, Friday was not the right day for this because the broad market was lower and down, but over 158.15 should target 162.25, and there is a thin structure retracement to be had there. So as a scalp, something like this, but just noting that we're in a range, please don't overstay your welcome at the top end until and if we break out through the top end through that thin structure retracement. So there's a quick trade here, there's a scalp trade here, and then larger ideas probably start to stem from this if we get it, or if we just remain range bound, let's just kind of be neutral. Let's not really take an aggressive stance if we're just noodling around between 162.25 and 152.50. Underneath 152.50, nothing here. Nothing here, probably looking at 144.75 as a potential target. Okay, that is Palantir. Let's jump on into Broadcom. They do have earnings this week, but the big pattern, of course, is the head and shoulders, right? So if we break down underneath 287.25, it could be earnings or otherwise. I would generally take my stance on the tech side of the market, semiconductors, and tone it down a notch, right? So watching that very closely. Earnings have the possibility to blow out any analysis that we do here. So I'm not going to get overly committed to a positional or directional thesis on Broadcom other than just watching 287.25 or the all-time high at 317.25. If Broadcom miraculously gaps up to here, then the party continues, the music continues, and we continue to keep that risk-on stance. We'll only know Thursday after the close. Let's take a look at AMD. AMD in terms of semiconductors also looks fairly weak here. Double top, not quite breaking the neckline yet, but clearly a lower high in place. You could call this bear flag consolidation. Underneath 160, your daily 50 SMA, things likely get a little bit worse, trying to navigate towards this gap close and the origin of sort of this most recent rally in the upward direction. It's 151, 147.60 is the closure, and then 142.75 is the number down below. If you get this consolidation to remain in the flag and you Brigade bolt out of it, I think paired with perhaps a little bit more optimism around Broadcom earnings, this could be a compelling argument, right? Do we have shorts who are starting to get involved? Do we have this cool-off phase right into the daily 50, which we're going to pick it up from at that point? It's possible. It's definitely possible. We've not kissed the daily 50 in quite some time. I would think that the other compelling thing going on here for AMD is just that this previous pivot high, we could even go out to a weekly chart to see this, right? You've tapped this resistance, that's fine, but this pivot high is kind of right near the neckline, so to speak. So if we get more acceptance below versus that break back over 169.50 we were just talking about, you would have your answer in terms of how are we resolving the higher time frames here, and does the market pull back a little bit more aggressively? The answer would seemingly be yes, as in if we take out that 160, right? Because now you're not getting that squeeze back over the 169.50 previous weekly pivot. All right, that is AMD in a nutshell. We can go down to the hourly chart, I suppose. Let's set this back to the daily. Here is the hourly. So pretty weak on that Friday session, breaking down through the bear flag trend line, if you will. So consolidation on these lows, I would not be fishing for longs. I would only really start fishing for longs for this thin structure retracement and the gap close if there's a move over 169.50. There was an attempt for that on Thursday. There was not really clean enough broad market action or even AMD action. If you take a look at the 2-minute chart, it's actually quite ugly. Let's go over here to a couple days. You know, look at these upper wicks, right? You weren't really hammering off the level. As a matter of fact, you were just rejecting high of the day. So very ugly hold. It was a hold nonetheless, but there was really no trigger to get in long there on that sort of wick action. So 169.50 failures don't really strike me as the best idea, noting how the market's responded there in the past. But if we're going to squeeze out, if there's Broadcom optimism, perhaps that does end up playing as a potential idea. 169.50. Anyways, continue along to Robinhood. Everybody and their sisters, brothers, mothers, aunts, goldfish can see this as well. You could see, here's your little man ray pattern. There's your head and shoulders. I don't think anybody's really unique for calling it out. Again, it's about how we execute around it. What happens here at $100.75? Do we front run it? Do we get blown up if the market does this? Or do we wait patiently? Do we look for the Brigade bolt underneath? And then do we execute on the idea? That's probably what we're looking for. In terms of up and downs, the lower high rejection in here, underneath the neckline of the top of the pattern, which is just a double top to make up the head and shoulders, that gets you your man ray. The lower high is right off the neckline. So to me, bearish consolidation will remain in play underneath 107.50, and the breakdown is here to bring in a lower low under this previous pivot low at $100.75. On the hourly time scale, I was a little surprised on Friday that Robinhood was not, because it opened right at the lows of what could be seen as sort of a descending triangle here. It did not accelerate towards the $100.75 mark. So I think the first thought is neutral here. If we do Brigade bolt underneath, it gets us to the break point, and then we really want to see that collapse underneath $100.75 to actively trade those shorts. If we're just chopping around in the range, again, neutral. If we do rally, I would be open-minded again for a possible lower high, noting like your daily lower highs at this point, up against $107.50. So this rally rejection could still be a play as well, right? Noting that we are flipping into a little bit of, not even a little bit, we are just in an hourly downtrend via these lower highs, and 107.50 could produce the next rejection point. Okay, that is Robinhood to the downside. Let's flip back over to the dailies, and I've got 4 trade ideas for you. Ironically, many of them in tech to some degree. So, and they're somewhat bullish, right? Pure Storage. Let's take a look. Oops, if I could spell PSTG is what I'm looking for. Pure Storage. There we go. This is a new all-time high on the earnings gap up. So very interested in seeing what happens with this inside bullish 3-bar play. It's not the most compelling upper wick from Friday. Don't get it twisted. I'm not sitting here saying that it's like ripe for a breakout. It's just got to continue. But if we do get over $80.60, I mean, that's a pretty good looking chart up here. High and tight consolidation post earnings, new all-time highs. There's nothing to really stop the market. So first step would at bare minimum be some kind of consolidation here. That keeps me interested. And then over the actual number at 80.60 is where I would start to think about executions on PSTG, pure storage. So that's the upside there. A lot of this is earnings related as well as momentum related in terms of sympathy. Okay, so that's PSTG. Let's go back to the daily. Again, not the best upper wick, but I like the fact that this is a pullback, not even over or under, I should say, the 50% mark of the range here, as the broad market clearly pulled back more aggressively. All right, that is what we've got there. If it just drifts off, I would let it be until a new setup forms. Pure storage number one. Let's go on over to MDB, Mongo Database, MDB. Another chart that looks eerily similar. Here's a large gap up on earnings. Here's a multi-day follow-through, 1 day of pause on Friday. It's not a big breakdown bar like the S&P or the NASDAQ. 2 equal highs, inside bullish 3-bar play. Let's take a look on the hourly chart. Big gap to close overhead. Over 320.75 likely starts to close that gap to 345.50. If you go back to the daily, you can see this as a previous earnings cycle from back here. We are breaking what has clearly been a pretty severe downtrend via these lower highs. This clearly has a higher high here and a higher high here. So question just becomes, is Mongo ready for a firm trend reversal? And are we going to close that gap overhead? Does it have more momentum left in the tank? That is something to be watching for here on MDB. So some of these names, momentum, right? Momentum. Snowflake earnings certainly have some momentum. Let's continue along though to AppLovin. This name also has a bullish 3-bar play. And again, I'm fully acknowledging that like the QQQ analysis does not align with these breakouts, but we know that the Qs and the NASDAQ generally is suffering more so based on semiconductors. Question for you. Pure storage, semiconductors or no? No. Mongo database, semiconductors or no? No. App, semiconductors or no? Right? You see where I'm going with that. It's the right side. It's the right part, so to speak, of the sector when it comes to technology. So app, inside bullish 3-bar play. Very simple stuff. Over 473, over 487.50 gets your upside continuation. And your target here on the upside is this prior set of highs at 514.25. If we can get there, that would be one heck of a move. So app on the upside there. Let's finish up with the final idea. It's loosely related to NVIDIA, so maybe a little bit more semiconductor related here, which is why CRWV is the last but not least. What do we have? Data center, of course, right? So be mindful of the weakness in semis, but what I find compelling about this chart is that it closed the gap and reversed on the Friday session. CoreWeave has this very interesting potential breakout over 106.25 daily 20 SMA. You're going to need to see it go first. I would not just long the hammer high of Friday. I want to see it over the level, and then we have this really thin structure retracement from when the insider window opened up for sale of shares, right? So watching closely 106.25, if you take a look at the hourly chart, you could see this, right? Maybe you're getting a little bit of a rounded bottom in here. It's one potential way to classify it. But you can clearly see where the thin structure starts. There's your little intraday lower high for the end of day dribble. If you get over that and the daily 20, that's where you've got some smooth sailing up towards about 122.85. So even if you don't make it all the way to the target, if you make half of it, if you make a quarter of it, right, and you can find intraday risk that looks like that, that's a fantastic trading opportunity in my opinion. So CoreWeave will be on the list this upcoming week as a top priority. That's what I've got for you in this week's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. Remember that the market is closed on Monday. We may or may not do a pre-market prep Q&A type thing. I don't know, probably leaning towards not. Let's just enjoy the long weekend. We're already working on a Saturday over the long weekend, but the prep has been done. We are all set for coming into the day on that Tuesday session. So if you enjoyed the video, again, do all that stuff down below, comments, likes, all that stuff. Check out the links listed down below in the description. We will be live regardless on Tuesday morning at 8 o'clock Eastern time for another episode of the pre-market prep. We'll see you back here on the channel for that analysis. Hope you have a fantastic weekend. And as always, I will see you in the next one.